In this video, I will be analyzing Dividend Stock Cisco using my stock screener and valuation spreadsheet. I will go over the fundamentals and value the company using my 4 different valuation methods: discounted cash flow, Benjamin Graham model, multiples model, and the dividend discount model to come to a buy price that I would be willing to pay for the company. If you're new here, don't forget to subscribe. Cisco Systems is a tech company in the communication equipment sector. They develop, manufacture and sell networking hardware, software, telecommunications equipment and other high technology services and products. The company has a dividend of 1.52 with a dividend yield of 3.2%, which makes this a medium to high paying dividend stock. The dividend payout is 51%, so that's pretty healthy and it shows room for potential growth. In terms of its technicals, is currently 30% down from its 52-week high and 22% up from its 52-week low. The beta is 0.98. Ideally this should be below 1 because 1 represents the market. So this is fairly stable in comparison to the market. So now let's look at the key metrics. This is just a few of the metrics I like to glance at before I deep dive into a company. In terms of its key metrics, the company has a PE ratio of 17, which is below my desired threshold of 20, so that's good. The company has shown its revenue growth over the past 5 years of 1.4%. So it's good that the company is still growing and it is showing its increase in market share. It has a healthy profit margin of 23% and its current ratio is above 1. So ideally I'd like to see this above 1. So the current ratio basically is the current assets over its current liabilities, and its debt to equity, this should be below 1, is 0.24. and its long-term debt to equity is also below 1. So this to me shows that the company is in a very good financial position. In terms of its price to free cash flow, the company is 26. So ideally I'd like to see this below 20, but that is very ambitious in the current market conditions. Before I get into the valuations, if you want more info on the models that I use or how I come to the figures, then do subscribe to the channel, as I will be going over my different models and how to calculate them in future videos. So in terms of valuation, firstly I will be looking at the discounted cash flow. This is a very popular method that is used to value stock. So what happens is they use the free cash flow for the company over the past 5 years to get an average growth rate in free cash flow, and then this sort of gets put into my spreadsheet to predict future cash flow for the next 5 years. So over the past few years, the average growth rate has been minus 4.9%. So I'm being a bit conservative with my projections here and assuming a growth rate of minus 5% over the next 5 years. So if I scroll down, I've got all of these figures inputted into my spreadsheet, and that gives me a total discounted cash flow valuation of 57.83. Now let's look at the Benjamin Graham model. I have used a growth rate of 5. So according to the analyst estimates, we have a growth rate for the next 5 years of 6.78. So I've just done slightly less than that here just to be a bit more conservative, and I've used the AAA corporate bond yield of 4.77, which is the latest number that I had when I searched it on Google. So this gives me an intrinsic value of 30.55. The Benjamin Graham model does usually give me the most conservative valuation. The next model I'll be looking at on my valuation spreadsheet is the multiples model. So what this does is it looks at other similar companies in the same industry and uses its stock price and earnings per share to come to a PE multiple. So from this I get the average PE and I multiply this by the earnings per share for Cisco. So in this case I come to a valuation for Cisco of $79.09. Now I will go on to my final valuation metric, which is the dividend discount model. So what this does is it calculates the dividend payouts and its yearly dividends to get a growth rate of its dividend increases. So over the past few years, we have an average growth rate of 3.6, and I've used the weighted average cost of capital of 7%, which I believe is the industry standard for Cisco Systems. And this comes to an intrinsic value of 46.31. So now let's go back to our original screen where I have the initial overview of the company. So if I scroll down, I can go to my valuation section. If I look at these figures, these are taken from the figures that we just calculated. So 57.83 is the discounted cash flow figure here. And then obviously you've also got the Benjamin Gray model here, and the multiples model from this tab here, and the dividend discount model from this tab here. So this gives me an intrinsic value of 53.45, which is basically an average of these four valuations. So the current price is 47.48, so there's quite a discount with the current price and the stock valuation. However, what I like to do is have a margin of safety. So I've included a margin of safety of 10%, which comes to an acceptable buy price for the company of 48.7. So for me, that is currently a buy of 2.5%. Analysts also project this company to overperform. I've also compared my stock valuation with other sources online. So according to Yahoo Finance, they have a valuation of 55.5, which is slightly above mine. And also Simply Wall Street have a valuation of 66.77. So their valuations do come in higher than mine. But as you saw from my video, I was conservative. I do believe it's important to be conservative in the current climate and give yourself a margin of safety. Remember to always do your own research and use your own assumptions before investing, because this is not financial advice. Let me know if you liked my spreadsheet in the comments below, or whether you agree or disagree with the valuation. I do have more content planned going over other dividend stocks in the future, so do subscribe to the channel.